So I'm not funding shows. Jesus Christ. Cashflow Chronicles. I don't know why I'm just a mess. I'm not paying attention whatsoever. So appreciate everybody. We took a week off. That's probably why I'm out of sync here, but very happy to be back with Hot Chris, the Daisy God, as some may call him, or maybe just me. But anyway, very happy to be back in the sack with him and talking about God knows what. But Chris, I'm just fumbling, so I'm just gonna hand it over to you. What's going on?
Yeah, I think the summer's over now, so a lot of people are coming back to get back to work. A lot of vacations are finally over. Kids are starting to go back to school again, especially I think on the East Coast here. So yeah, I think it's an interesting time. I think the market is a little bit of at a standstill. September tends to be a month that the performance is not that good, but there are a lot of key events that usually happen in September that are worth keeping an eye on. One of the things that I love to do is look at the leap contracts that typically come out, because what happens is if you go to the CBOE, let me just pull that up real quick. Leap
Yeah,
contracts.
you guys pulled
Yeah.
that up you talked about it the other day. Like I looked it up after you guys were talking about it. So
hmm
2026 contracts are coming out on September 11th, so next Monday, so about a week from today. And so I was getting
Yep.
kind of fired up because there is some opportunities that I'm looking at to potentially. And by the way, I don't know if you know I've been doing this. You
hmm
mentioned Weight Watchers, and
hmm
so I bought a leap. The one that wasn't really a leap, but it was kind of like a longer-ish call,
hmm
and I just been running a poor man cover call on it this whole time. And so I've already
Nice.
got my cost basis back, and I'm like, at this point, I'm like, do I just sell out of it? I mean, it wasn't a lot of money; it was a couple $100. Normally, my positions are in the tens of thousands of dollars. But
Yeah.
anyway, like I was just like, do I just keep writing it until January? I'm like, I don't
Why
know.
not?
Anyway, yeah, I might as well.
Well, here's what's going on in the world of GLP-1 medications. Okay, the whole thesis behind Weight Watchers was actually the prevalence of GLP-1 medication. So let me just show you guys what I'm talking about real quick. Um, so this is Weight Watchers right now. They've had a pretty not so good decade, where basically a lot of their they had like these moments where they had downturns, and then they had a run up when Oprah joined the board, and then Oprah kind of left the board. Well, actually, no, she's still on the board, but she's not as involved anymore. And then it had dropped down to like $3. The thing is with Weight Watchers that it's still there is still a captive audience for it. But what really set Weight Watchers apart and was actually a great time to buy in and let it ride up was when they shifted over to being able to prescribe GLP-1 medications, which are like Ozempic and Wegovy. These are kind of like game changers when it comes to weight loss. So it's one time injection per week, and the results are actually pretty substantive for people. So it's actually helping like a lot of people lose weight. And yeah, the only thing is it's not covered yet for weight loss as an indication. Um, so insurances don't typically cover it. It's mostly for diabetics, but it works. Like it's super effective.
Mhm.
The only things about it is that there are some side effects that are involved with it. The cost out of pocket is relatively high. I think it's between $500 to $1,000, and then on top of it, you kind of have to take them forever. And if you don't, like if you stop taking it, you'll gain the weight back. So at least
Right.
the people that they did the clinical trials, when they stopped, they gained the weight back. So some people think that actually if you basically start taking it and then slowly wean yourself off by also having a good diet, like a regimented diet and exercise plan at the same time, it could really help out, like, and help reduce down, like, obesity rates, especially in the
Mhm.
US. So there's another manufacturer that makes, well, the two main manufacturers. Actually, let me share the screen again real quick.
And by the way,
And actually,
I
I
met one
posted
or two
about,
people at work that
yeah.
actually have started it, and they've seen great results. But I'm like,
Mhm.
because I'm a bigger dude, right? So I've actually thought about it personally as well. And people are like, dude, you just don't eat anything, right? Like you just are not hungry
Yeah.
whatsoever. And so the thought is like if you're a person that eats out a lot or spends a lot on groceries or snacks a lot, it's like the $800. It might seem like a lot, but it might actually help you a little bit because if you're not buying those expensive snacks or going out to expensive dinners, it might offset some of that cost. So it might not be
Mhm.
100% out of pocket, right?
Yeah, exactly. I actually was very bullish on Novo Nordisk, which is the primary maker of Ozempic, back in November. So I still have the position. It's yeah, the GLP-1 demand is just crazy. This class of drug, it's just recently started releasing, and you can just see here, trizepatide is one that that Eli Lilly just released. But you can see here their sales growth for their GLP-1 medications. It's just crazy, and so there's a huge game changer. And the thing is, the entire world is going through an obesity epidemic. So I think a lot of people think it's just the United States that everyone is gaining weight, but the truth is, if you look around the world, like Korea, like this is the amount of people that are considered obese per country. So here we're at the top of the list. Here in the US, Mexico high, England is about 35%. Just think about how many people this totals up to, right? So the market potential for this one drug is huge. Well, not drug, but drug class is huge. So like let's say we look at Novo Nordisk stock, they have actually done amazing the last year since I started buying them. You know, they're at 103. It's at $190. There's still, you know, a lot of room to run, in my opinion. It's just the easy money is pretty much done.
Right.
Yeah. The other one, is, of course, is Eli Lilly. Eli Lilly has a medication called Manjaro that's even more effective than the Novo Nordisk one, and
Oh
you can
man.
see them.
My
They've
my
just been
mom was
killing it in
telling
the
me
market.
about it. So like
Yeah.
believe it or not, like I've never really got into the whole drug world or like new drugs that have come out that are helping people like depression medication stuff like that. This one is like I know you talk about it a good bit, but I've heard it from like just in public. People just
Mhm.
openly talking about it and I've never really heard of something that has really been out and about like this to an extent other than like
Mhm.
maybe Adderall, right? Like because people take Adderall over the counter all the time, and so
No, no,
it's
no, no.
pretty.
Adderall is you can't take Adderall over the counter. Just letting you
Yeah,
know. I
I
mean,
misspoke, but people are
yeah,
like they're I know you know what I meant. I meant to say
yeah,
like people are basically finding ways to get it anyway.
yeah, yeah. Well, the thing is, you can get it. There are like there's a way to get it where you can go to like a compounding pharmacy and basically they'll do telemedicine visits and you can, you know, and I'm not going to go too far into it because I'm not a doctor. You should always consult your physician before, you know, taking any medications and all this other stuff. But yeah, the drugs are actually very helpful for those in really bad shape in terms of diabetes. Like, you know, when you're young, it's easier to control your weight, but as you get older, your metabolism starts slowing down. And, you know, over time, it's just something that becomes like obesity leads to all sorts of like secondary complications like diabetes, your rate of the rate of cancer goes up. You know, your there's just like I said, so many complications to diabetes. So this could theoretically help a lot of people, but the only thing is like in terms of monetization, it's rather expensive for everyone because it's not off patent. You know, when maybe it goes off patent, it'll be a different story. But
Yeah,
the key to it is from an investing standpoint they could be really big winners. In my opinion, Eli Lilly has another drug coming out, like a third drug that's a triple acting formula that they've seen almost like 27 to 30% weight percent body weight loss in like 6 months. Think about
Jesus.
that 30%. So if you're
Is
like
that also going
260.
to be subcutaneous, or is that going to be
Yeah,
pill, or
it's
what?
sub
Yeah.
Q. It's sub Q. And then Pfizer is working on a GLP-1 medication. Though they had two GLP-1 medications that were oral, but one of them they stopped development. The other one is still very early in its development phase. But the one that like I'm really excited about is Eli Lilly. I think Eli Lilly could theoretically end up becoming the world's biggest pharmaceutical manufacturer at one point because
Mm,
there's just the profitability on these things is so much. There's a
right.
huge market for it. So yeah, it's nuts. There are some price targets that I'd probably keep an eye on when it comes to Eli Lilly and also for Novo Nordisk. But but yeah, it's just maybe I'll talk about it another time when I'm
Yeah,
done
it's
doing my
crazy
DD.
because my
Yeah.
earlier this year, like my mom never talks to me about stocks, right? Her and my dad were both very much like it's for crooks, right? The market's rigged, you know. But she'll reach out to me every once in a while. Two companies that she's talked to me about in the recent future is Amazon and Eli Lilly. And Eli Lilly was because of the GLP-1 stuff. So I wish I had
Yeah.
listened to her and looked more into it. And I was just like, oh, they've already run up 100%. Like they've already, this was probably like 6 months to 7 months ago, early beginning of 2023. And I was like, you know, it's probably already run, you know, I think at the time it was already up 100%. I was like, there's no reason for me to, you know, pick it while it's already hot, right? Buy low, sell high, not buy high, sell low, right? So I
Yeah.
was just like, I kind of stood away. I was like, who knows what this will actually do? And I should have kind of kept up with it, but I
Mhm.
did not, unfortunately. But before we
Yeah.
move on, do you have any other thoughts that you wanted to finish up with? I was going to either kick us off in talking about historically, you know, what it's like to invest in the second half of the year, which was a point that you brought up before we started talking. Or I don't know if I've ever shared with you my top 10 positions in the portfolio. So we
No,
could go
what's your
either
top
route.
10? Let's take a
Okay.
look.
So I did share this on Sunday, but I recognize that you weren't here. And so it's a good opportunity also because not everybody, it was kind of like a really late stream. And so sharing it was probably, you know, some people have probably seen it at this point. I've also released it as a video, but it's a quick opportunity to look at it as well. And so I think a lot of people don't really know where I stand, right? They're like, is this guy 100% Palantir? Is this guy 100%, you know, in dividend stocks? Because I fall in all the communities, and you're kind of a jack of all trades in that respect as well, right?
Mhm.
But so this is about the top 10 positions. I have about probably 20-25 different positions that I've simplified it down to, and maybe like 4 or 5 really small, like less than $1,500. I don't even consider positions, right? But this is kind of the top 10. And so with that, majority of that top 10 are probably like 20 to 25% of my net worth is in SPY or SPY equivalents. And the reason why it's SPY in equivalents is because some of this is 401k money as well. So I've kind of made it a SPY sort of equivalent with respect to how many shares it is, annual dividends, all that stuff. But it's about 300 or so $1,000. And so that's a pretty good majority of it. My hope is
Yeah.
eventually just on the individual brokerage account to get it to $1,000 a quarter in dividends, because I'm at about 500 or so, maybe 600 or so and a quarter in my individual brokerage account in SPY. I would love to get that to 1,000, because then you're buying like 2 or 3 shares a quarter, and I feel like that is just going to explode on itself just from that reinvestment. Um, so I don't know if you have any thoughts about that before I kick it off into two through 10. Did I lose you?
Sorry. 1 second.
Very good. So number 2, self-explanatory, UDOC. For those of you guys that don't know, I work for an undisclosed oil company, and so with that, I get a little bit of shares. So I don't just for HR reasons, I don't like to share the company
Yeah.
that I generally work for. If you really want to know, you know, feel free to scavenge the internet. It's not that hard, but you know, just to keep it out of the videos, so I can't be called into HR and be like, hey, you can't be going out here telling everybody who you work for.
Yeah. I'm surprised you don't have SLG on this chart.
SLG is way smaller. It's like only a
Ah,
10 or
oh, gotcha.
$15,000 position. I mean, I have
Gotcha.
300
Gotcha.
some shares, but it's
Gotcha.
just
Okay.
it was one of those ones where I was going to hopefully accumulate over time, and then unfortunately
Gotcha.
it skyrocketed up pretty quick. It's up like
Yeah.
50-60%, and it's even better for you. I think you were buying it in the low 20s. I think
20s.
yeah,
Yeah.
my basis is like 24 or something like that, so not as good as yours.
Nice.
Yeah, but
Nice.
still
Yeah.
a good opportunity. And I have
Yeah.
puts in my individual brokerage account that I sold. So
Mhm.
anytime it does a little bit of a dip,
You
I'll
sell the
sell some
puts.
more. Yeah, and I keep rolling it.
Nice.
It's like every 45 days, and if it goes up like 50%, I'll buy it back and then move
Mhm.
the expiration date, just because, you know, I'm
Nice.
just letting theta burn and all that shit. So anyway,
Nice.
Palantir is probably not too surprising. 4,000 shares of that. So when it ran to close to 20 or over $20, it was the number 2 position of the portfolio. Hopefully, I think it'll solidify itself as the number 2 or so position in the portfolio, unless you have some of these other ones. Then you have TQQQ, which is a huge gamble. I think I told you that I
Triple
have
leverage.
yeah. And you're like, are you holding that? So I've been holding this for a while, and it was down like 60% at one point. So I've been accumulating this throughout 2020 and 2021, and even some parts of 2022. And it's only like 15% down overall. And so if we go into a decent bull run, and my anticipation is the following. I don't know how you feel about this. I think by 2030, we're going to be looking at a SPY of about 9 to 10,000, an S&P of 9 to 10,000. So I think we're going to double. So if that's the case, I feel like this thing is going to do a little bit of running. It might be 200%, might be 300%, but I think that we'll see, right? And I'm okay gambling $65,000 worth on something that could potentially be, several $100,000 worth of a position. If I lost 65 grand, I'd probably slap myself in the face once or twice, but I'm not going to jump off a 25th story building like I'm living in right now. So, that's that. And I don't advise anybody or, really try to push that. But then again, I have a very decently sized portfolio, as you guys can see here. $65,000, while it might be a lot to some of you, it's not going to break my bank, right? So there's that. You have Shell, so 50,000 odd shares of that. This is just a oil play. I think it's a good dividend producer for me. And then also I have a feeling that Shell will do a good job when the time is right, really transitioning their portfolio in the long term. So this is more of a play that in the next 5 years or so, they will transition a lot more towards the renewable side, and they will do really well. For an example, we talk a little bit about the cash flow from operations that like Google, Apple, all those companies have. If you looked at how much money Google made in cash flow from operations in 2022, you would think that it's $1 trillion company up there with the Googles and stuff of the world. But unfortunately, it's a $240 billion company just because of the cyclical nature, right? And you and I talked about that a couple weeks ago, which is like, some companies, because of the sustainability of their revenue streams, will get paid a premium. This is one of those companies that won't get paid a premium. One, very capital intensive business. Two, very cyclical business. So there's that. Then you got the Googles and Amazons of the world. Those sitting at just under, I want to get those to 400 shares here pretty soon. So hopefully by the end of the year, if I consolidate some stuff, maybe Johnson & Johnson and Pepsi, which I'll talk about in just a second. Hope to get those closer to 400 shares, but also the prices run up a good bit as well. So I'm like, I'll wait for a good opportunity to maybe consolidate if I see it necessary. The next two, Jeppy and Devo, are kind of hangovers from like 2019 and 2020 when I was very focused on dividend income. And so I contemplate selling these all the time because they do provide great dividend income. As you can see, they're like 9 and 5% sort of yielders. And they provide about $6,000-$7,000 worth of income a year. But at the same time, they don't my objectives for my portfolio have changed, right? Originally, I was really going for, hey, let's make $35,000, $40,000 a year in dividend income. And then once I kind of got to that point where I could easily see myself, if I focused my positions into specific stocks like Jeppy, Devo, and stuff of the like, I was like, this isn't going to change my life, right? I was like, I could get to 2.5, 3 million and be making some decent money off of these Jeppy and Devo in terms of income, but like, it's not going to fundamentally change my quality of life or like where I am in terms of like the social circles and stuff like that. So that's why I sort of sold out of some of those positions and rebalanced them into, say, the Apples and the Googles and the Amazons of the world, because I anticipate those will be things that double, triple in the coming years versus a Jeppy and Devo. They will probably stay flat from a principal perspective, but they'll pay a decent income based off the covered calls that they're writing. So just recognize that this always kind of goes back to what objectives. And so if I have anything that's on the chopping block, the thing that's nice about them, which sucks, is like it's $7,000 worth of income And it's like, but I don't need the income, right? I still have a 9 to 5 job and I reinvest all my dividends. So it's kind of like a catch-22. It's like you want that security blanket of $7,000 a year in income, but at the same time, you're dragging your own portfolio because it should be in something like a SPY or something that will grow over the next 5 to 10 years. But instead, it's kind of stuck in this very stagnant, dividend pair. So
Not to mention you pay taxes on it, right? Because you're already at a high marginal tax rate. So if you
exactly.
think about it, even if you're getting 8.9% return dividend, what you're doing is about 30 to 40% of that, depending on where you live, is going to go back to Uncle Sam, depending on
Very
your
good.
marginal tax rate. So that's one of the things you have to also think about, being tax efficient and what age you're in. So for me, when I look at these things, I'm like, these things are perfect for people who are semi-retired or are retired, because the thing is, you have no real income coming in other than maybe Social Security and a pension. So all the tax rates that you have will be in a much better place.
Right.
So that's where a lot of people tend to get a little bit yield start, like they feel like the yield is the thing that they want to chase after, and they don't necessarily look at the capital appreciation part of it. So it's just something that you live and you learn. So this is the first time in a long time, though, I feel like there are a lot of companies out there that are trading way below book. Their dividends are fine because the cash flows are coming in. So you're getting an attractive dividend, and the likelihood that under a recovery scenario, you'll see the stock actually ride back up too. So it's like this doesn't happen very often. So a lot of these opportunities are in, like I've been saying, in the commercial REITs and in the regional banks. Maybe one of these days we should do like a dedicated episode to like the regional
Deep
banks,
dive.
because because
That would
under
be
the
cool.
right yeah,
Yeah.
under the right scenario that's coming up with lower interest rates coming forward, most of their book values are going to end up recovering. And because their cash flows are fine, they're still able to generate a meaningful return from non-interest income. It's like, to me, a lot of this stuff seems like a no-brainer. It's just a matter of being patient and finding the right regional banks and finding how undervalued they really are, and just sitting back, collecting dividends while getting capital appreciation. How cool is that?
Yeah.
The
I
other,
did.
yeah,
Sorry,
go
go
ahead.
ahead.
Sorry.
No, I didn't mean to cut you off. Go ahead.
No, the other thing is, um, a lot of times what happens is you see a high dividend yield number and you automatically think, oh, that's where I want to be. To be honest, a lot of times you kind of want to be in the one that has sustained dividend growth over a long period of time, because what it is you're getting in at a really good price. So the stock price will naturally climb, but then also the dividend will climb also. So if you look for that company that's yielding a 7-8% dividend, you're like, yeah, this is the one I want to be in because I'm getting an 8% return. But then you look at on the capital side where the stock has been relatively flat or maybe growing just a little bit. That's not where you want to be. You want to be in the one that's been literally like going this way and growing the dividend at the same time. I mean, look at
Right.
Apple, right? Apple is a great example of that. If you got in 2008. So right now, some people look at Apple that are dividend investors and they're like, oh, well, Apple's only giving a 1% dividend. Yeah, but if you got in way earlier, your dividend payout right now would have been almost 15-16%
Oh, never
on
mind.
a
Stop.
yield basis had you bought in at an earlier time.
Yeah. On my other sheet, I have it like connected. So if you type in AAPL,
Yeah.
it'll bring up all. But this one's kind of a look table. Um,
Yeah.
Interesting. Yeah. No, I agree with you there. It's like if you're really looking for that growth over the long term, the sweet spot for me is like 1.5 to 2.5%. It's like at that point, they're dedicated to the dividend, but at the same time, the company is still in kind of growth mode. And exactly what you said, like if you look at the Altria groups of the world, or you look at some of these other companies that are really just giving cash back to the shareholders, it's because they're mature, right? There's nothing else that they can reinvest back into the company from an R&D perspective or anything like that. It's the same reason why Pepsi, for an example, is in like the 2.5 to 3% range instead of like an 8% range, because they keep acquiring SodaStream and they keep coming out with new brands and they keep continuing to grow the business. Versus look at like some of these cigarette companies, Altria Group, Philip Morris. Philip Morris is trying to diversify back into the medical side, so that might be kind of an outlier as of the past year or so. But generally speaking, they're volumes were declining, and all they would do is increase their margins and increase like what they're selling them for, just to kind of keep up with revenues. So it's like you have
Yeah.
this declining like customer base over time, declining 2 to 3% per year, but yet you're increasing your revenue just based off of the fact that you're increasing the amount that you're selling it for. And so what are you going to do? Well, you can't reinvest back into the business, so you're just going to give that out a share, like, you know, dividends or share buybacks or what have you. It's like, is
Yeah.
that really like, and I didn't really perceive that really when I was growing in the first 5 or so years of investing.
Hmm.
I was just like, oh, they're paying me, right? Like that's what I want. I want that dividend. I want that income now versus like however many years down the road. But then you start to recognize it's like they're giving out so much in dividends and share buybacks because that's all they can do. They can't put that
Yeah.
money elsewhere. They're not a Google, right? Like Google, they can buy
Mhm.
back, you know, people like with Google and Amazon, but you look at how much they're reinvesting back into the company still, and how much they're kind of like acquiring different companies for. And then they also still are giving out these buybacks. It's like, but they're not just relying on the company to just, you know, give back shares and dividends and stuff like that. So
Yeah.
that's one thing that I didn't really click for me until about 2020 and 2021 when I started seeing some of these companies. I was like, I just don't understand it. Like, why isn't Ultra Group blowing up like all these other companies? Why isn't Pepsi? Why isn't this? Why isn't that? And I started to kind of really make it click that it's like buybacks are very short-term focused. Like the reason why companies do buybacks, maybe this is getting too down a rabbit hole and feel free to cut me off. The reason
Mhm.
why companies do buybacks is because it's requested by the shareholders. Well, the majority of the shareholders are BlackRock, Vanguard, and State Street. So they're the ones that are actually requesting it. And another piece is at the board level, they say we want to grow earnings per share by 10% a year. Well, what's a very
Mhm.
easy way to grow earnings per share is to buy back stock, right?
Yep.
You're able to basically eliminate 5-10% of the stock, grow your revenue a little bit, grow your, you know, your net profit a little bit. Now you have 5% less stock. You grew your revenue by 5%, your net profit by 5%, boom, your earnings per share goes up 10%. And it's like, oh
Yeah.
wow. But to me, that's not really good. It can be good. Like in the case of like AutoZone, like we saw that, like that can
Yeah.
be really good. But most of the time, I would say share buybacks are just like a very short term thing. Something happens to the company, they need capital, then the shares go out of proportion in terms of like share based compensation or God knows what. So it can be executed well, but a lot of times it struggles to an extent.
Yeah. I mean, and there's times where share buybacks have always been like, I don't want to say always, but they also lead to a lot of bad moves. Like, if you've seen the amount of buybacks that like Bed Bath and Beyond did, where
Mm,
basically they, when times were good, they bought back a bunch of shares, which is really bad because the thing is their business was on the decline and yet they're buying back shares and then now they're bankrupt. Why? Because they
mhm.
spend all their money instead of reinvesting it back into the business and making the business better, they ended up just screwing themselves over. So I've seen buybacks, if the company doesn't do good buybacks at a good price, um, then yeah, it's they're not good thing. But they're also, depending on what sector you're in, could be something that has like a way that, you know, reward shareholders over a long period of time without having to have them foot a lot of tax bills. Like the one company right now that I think is doing buybacks the best is probably Google, because from a valuation standpoint, they're very undervalued. They have a shit ton of money in terms of operating cash flow. So it just makes sense for them to buy back shares. Like, why sit on, and not to mention, they still have $100 billion in cash as a buffer. You
Right.
know, so it's not something that's like that. Oh, they need money for to do other things with. They just have such a cash heavy business, like that they're able to generate so much money that, you know, it doesn't, it's not worth just hoarding onto it
Yeah.
or other things. So in my opinion right now, the one that really, if you're trying to go for capital appreciation and it's relatively safe, I'd say it's Google. You know, I think a
Yeah.
lot of people are probably going to be selling out of some of their larger positions in some other companies, and once the numbers come out with Google, it'll just be, yeah.
Yeah.
Another one is and one of the people that put here as well, Stephen B. He put Atcore. Atcore is a is a basically it's an infrastructure play, but they had an exceptionally strong year because of PVC piping, but they have a shit ton of money in terms of cash flow right now. And they're utilizing some of that cash flow to buy back shares while the stock is like not depressed, but it's at a decent price. So do you think it's good that Adcore is buying back? Yeah, because overall their business is performing well. They're not in a bad shape, and they're generating meaningful cash flows. And right now, reinvesting that money into further acquisitions doesn't make sense. So instead,
Mhm.
especially if your business is doing really well, you don't need to you don't need to spend money on acquiring a company and then figuring out how to integrate it and everything else. Like if you look at some companies, they're like serial acquirers, right? Like a good example of that is like Salesforce. Salesforce has grown 30% year over year consistently for like the last, I think, 15 years. But the reason why is because every time they have any slowdown, they just buy up another big company that they swallow and integrate back into their office suite. I mean, well, their CRM suite. And it's a business model model that works for them. Another one is AVGO, Broadcom. Broadcom's a great company, man. Like, and they're still. I think Broad. I don't know if you're looking at any semiconductor companies right now, but I think Broadcom's actually a pretty good one. You know, they've got
Was it
great
Broadcom?
management.
I'm
Yeah,
trying to remember. There was one that another guy that I invest with, Cole. I think he might have been talking about Broadcom. It's kind of run up a little bit in price, if I remember correctly, but
yeah.
I
Oh,
think it's done
dude, you
overall.
kidding me? Look
Yeah,
at this. This is Broadcom
yeah,
over the last. Look at this since 2012. This is Broadcom right
yeah.
here. So a lot of people interpret Broadcom as almost like a roll up, where they serially acquire companies, integrate them into their business, and just. But what they do is they just make these businesses so much more efficient. And I think they just did an acquisition of VMware. One
That
second.
sounds right.
AVG.
But I
Yeah.
do want to highlight something
Broadcom.
that you mentioned that I don't think people are
Yeah.
fully understood, and I never really thought about it recently. And I remember hearing this about a year ago, and it made sense, which was the tax efficiency of buybacks compared to dividends, right? So let's just take Google for example. They're going to buy back $80 billion worth of stock. If they were to distribute that as say a dividend or a special dividend, just like you said, for me, you know, some people might have to pay a 15% tax. Some people might have to pay a 20% tax on that. So that alone, let's just make it easy on ourselves and say it was $100 billion worth of dividends given back. $20 billion worth of that would have to go back to the government based off of if people didn't have it in a Roth
Mhm.
IRA or something like that. Versus if they're buying back the stock, they can buy $100 billion worth of stock and not really have to pay too much in the tax application of or implications of things. So that's a really good thought that I haven't thought about in a while, but that makes a lot of sense as to why maybe these Black Rocks and Vanguards of the world are wanting to really promote, say, buybacks. And then the last
Yeah.
piece I'll say about it, I'll hand it back to you, is the shareholders want buybacks, meaning the Black Rocks, Vanguards of the world. Whose shares are they buying? They're not buying the other shares from BlackRock or Vanguard or State Street, right? They're holding their positions because they're obligated through ETFs and wealth management and everything like that. They're buying back the shares. Google or whomever is buying back the shares of their own company is buying from the retail investor like you and me, who is stupid enough to sell the shares or repositioning themselves, or other hedge funds that are repositioning themselves to move in and out of some of these stocks. So it just strengthens the position that BlackRock and State Street and Vanguard have. Their percentage of institutional ownership continues to go up. The retail ownership continues to go down. But anyway, I think that's another prime example and reason as to why they promote share buybacks to an extent. Anyway, back to you.
Yeah. No, it's just um the concept of share buybacks is great as an investor. The other thing is, some people they always ask me like, well, if I have a dividend income, that means I have an income stream. So if I need anything, I could always rely on that dividend. I'm like, bro, just rely on the capital appreciation. When you do need the money, just sell a few shares. Like no one is saying you can't sell shares. Like let's say I have 100,000 shares or 1,000 shares of a stock and I need money, right? Because I have to pay a bill or something. Okay, sell 2, 3 shares. That's it. The rest of the time you should be accumulating. So if you need the money, sell a little bit, pay the taxes on it, and it's much more tax efficient to do it that way than to want to get a dividend just so that you use the dividend to buy back more stock. Like,
Mhm.
you know what I mean? Like there's a lot of people that do dripping where they're like, oh, I'll take the dividends and I'll just buy back more stock. And it's like, there is one sector like REITs. REITs, they have to pay out. Like that's the
Mhm.
big difference between like a qualified dividend. And that's the other thing that people should learn, the difference between a qualified dividend that gets taxed at a certain rate versus ordinary income. Because depending on what you invest in, your tax implications could be much more different. Same thing with like an MLP.
MLP,
You'll get
yep.
a K1 tax, so there's tax advantages to that, and then there's downsides to it because the way that you have to file taxes. This is all stuff that like you'll learn over time as an investor. My whole thing is, if you just want the least amount of complication possible, just find some really good companies. Don't look at the dividend as hard as some of the other people will, and just buy the stock in that company and just let the capital appreciation do your job for you. Once in a while, there'll be a point where you can get capital appreciation and dividend appreciation. And I mean, and dividend growth and dividends at the same time. And it's like, wow, I'm getting the trifecta, which is rare, really rare. It doesn't happen as often
Mhm.
as I'd like.
I
So,
mean, I would
yeah.
anticipate that Google and Amazon at some point, probably not in the next 5 years or so, but I'd say maybe in 10 years, 5, 10 years, you might be able to start seeing them pay a small dividend, just like Apple started back in what, 2012, 2013
Hmm.
is when they kind of started their dividends. So, and to be fair, like people might give crap about the Apple dividend, right? But it started off very small, right? It started off when the company was like 300 or $400 billion or something like that, and it was a 1% dividend, and everyone kind of was just like, "That's a measly dividend. Why would you?" It was a $3 to $4 billion obligation for them a year because you're thinking $400 billion market cap, 1%, $4 billion. They're close to $3 trillion now. 1% of $3 trillion is $30 billion. So every single percentage point that they have to pay out in dividends is now $30 billion. So you have to think they have to generate. Imagine if they cut the dividend, how many people are say, oh my God, you know what I mean? Like when you establish a dividend, you're establishing a precedence that you will continue to pay that forward in perpetuity. And if you cut it, people are going to cut your knees off or cut you off
Yeah.
at the knees rather. So a buyback makes it a little bit more flexible, right? You can grant one this quarter, you can buy back some shares this quarter, but you don't have to guaranteed, do a buyback, right? You can kind of put those on pause versus a dividend. You're kind of obliging yourself. And one of the things that I saw, and then, I'll hand it back to you and we can kind of move on from the conversation. A lot of oil companies in 2020, because of the negative oil prices, took the opportunity to cut their dividend. And I think it was a big mistake for some of them to immediately reissue and like almost go back to 2/3 or almost 80% of the dividend payments that they were paying. Because if you have this opportunity to one, acquire other companies, reinvest in the transition and kind of move yourself into that direction instead of obliging yourself, like Shell, for example, they were like $15 billion a year or something in dividend obligation, and they cut it 2/3 down to 5 billion. And I was like, this is awesome, right? It gives them $10 billion of flexibility on an annualized basis to invest however they want. They can reinvest back into the upstream, they can focus on the downstream and create this fortress. But instead, immediately, as things kind of got better in a financial footing, they increased the dividend back to almost where it was. And so it's like you kind of you gave yourself $10 billion worth of annual leeway of needing to not necessarily pay a $10 billion dividend to the people. And then next thing you know, you're kind of giving that back and strangling yourself as an organization again. So just some thoughts about, what, when you think about dividends, what it actually truly means for the company and the impacts on cash flow, and maybe from like a higher level, and hopefully that helps some people out.
Yeah. Yeah. Oh man. Yep. So right now, are you looking at any new stocks, any new sectors? Because the thing is, for me, I'm so tapped out of new sectors.
Yeah.
The only one that I'm a little bit kind of doing more DD on, believe it or not, is local TV channels. I know that
Mm,
sounds weird, right? Like local TV and local, like, so a lot of people, they think when you just watch TV and stuff, it's ABC and Fox and all this other stuff. But a lot of these local channels, they're all owned like by different companies. And the
mhm,
reason why is because we have an election cycle coming up in the
mm.
next, like, year. So typically on election years, these companies, they go crazy with how much ad spending comes onto their systems.
I never thought
You
about
know,
that, but that's true.
yeah,
I didn't
yeah.
think about local like TV stations, but one that I have been in search of and I actually did relatively well in 2020, 2021 was not really regional banks, but almost like very small community banks, like banks that are less than like $2 billion. Right. So you're
Yeah,
focusing on banks that are probably like 10 to 20 billion when you're looking at, say, like the Regions banks or the Truists of the world. Truist is a lot bigger, but when you're focusing on that at that point, there's so many banks that they've already acquired. I was
yeah,
focusing on like this is in like a small like county bank. Like it's so small at this point that you probably never heard of it. Versus like Silicon Valley, people have probably heard of. Um, Pac West, people have probably heard of. But like I was looking at those particular banks and kind of going back to what you were talking about price to book, specifically for like commercial real estate. I was doing that in 2020 with the larger banks like Wells Fargo. JP Morgan never slipped below one because they always traded a
hmm,
premium, a price to
yep,
book. But all these other companies like Citi, I think probably still trades below price to book. I don't know why. I mean, it probably just the riskiness of what they do, and they don't necessarily have the best assets comparatively to maybe some of their counterparts. But maybe they trade above one book value now. But Wells Fargo, that was trading at like a 50 book value back in 2020. I loaded up on that when it was probably in like the all the way down. Like it went from the 50s all the way down to maybe it was the 40s, all the way down to like the teens. And I was loading up the entire way down. At one point, I had 1,000 shares of Wells Fargo. I got back to $50, and I was like, all this litigation that's coming out. Let me just get out of this thing, which was the right thing because now it's just kind of been stagnant. Um, but yeah, looking specifically at that, I'm curious what your thoughts are now that you bring it up. If you have any particular things that you want to
what do you
specifically
mean, like
share.
regional banks or
No,
oh,
the TV
yeah,
stations that you were
I'll
talking
show
about.
you, I'll show you right now. I actually was pulling it up. So have you heard of this before? Nexstar Media Group.
I want to say yes, but I don't. I wouldn't be able to tell you
So
specifically.
Nexstar Media Group, it's a very fairly small slash not so small company. It's about a $5 billion market cap. PE is about 7.7. Dividend yield of about 3.81%. Okay. They haven't really done that great over the last year. So you can see here they're down, right? But if you look at historically, look at this, the rate of
Hmm.
return that they've had, right? And what they do is they actually own a lot of media assets that are more local, right? So
Mm,
if you're listening to any of this stuff or watching any of these TV shows, they own that stuff, right? So you see here, look at all the networks, the TV stations, and all the stuff that they own. So it's one of those things that during an election cycle, you want to be very regional heavy focused because there's a lot of spending that's going to be happening. Look at this. This is all the stuff that they own,
that's so crazy. I have a
right?
question.
Yeah.
So on the
Yeah.
very far right column, right? I see Fox, CBS, ABC, NBC.
Yeah.
So
Mhm.
I know that those local stations, like I just always anticipated that they were partly owned by Fox or they were partly owned by CBS. Can you explain to
Yeah.
me what the hell is like? Is it like a franchise? Like what? How does these things show the fuck up? Like I'm just flabbergasted now that we're talking about it.
This might be something that, like, even I'm having some tough time really
Okay.
understanding myself. Um, I'm looking at purely based on numbers because I just started doing DD on this. Like,
Yeah, yeah, yeah. This is
I
really
haven't
cool.
done, I haven't gone really far into it yet. So I figure I'd just show you guys real quick. Hold on one second.
But it's the same
Uh,
thing. Like when Warren was always investing in Liberty Media Corp, I was like, "What the hell is he do? Like? What is Liberty Media Corp?
yeah,
Like all these small little things that you're like, it doesn't make any sense.
Come
And now
on, why is
Liberty
this
Media
not
Corp is
popping?
like the Atlanta Braves and Formula One. It's like they have so many different
Yeah.
businesses under one.
I'm trying to pull like their last quarter. Okay, there we go. So you can see here, I mean, right here, political advertising in 2023 compared to 2022 of June, 87 million. And this was like a midterm year.
Yeah, midterms.
2022 is a midterm year. Usually during like election cycles, damn it, let me find this investor presentation, man.
You know,
Because
it's like
yeah.
when Dumb Money, how they every year they've been kind of doing like Generac when the storms come
Mhm.
out. They're like, oh, it's starting to get to storm season. Got to get into Generac. I'm wondering if this is the same boat where it's like in 2022 you're investing, in 2024 you're investing, and every time it like you get after the election you just sell out, right, or the quarter after or whatever, because you know that political revenue is just going to drop out. I
Yeah.
think it's pretty funny, like because all stocks go through peaks and troughs, but I'm wondering if those peaks and troughs for this company completely correlate with for the election years or midterm years. That's pretty funny.
Um, well, not so much, but the thing is, like,
Uh,
they generate so much cash flow that they eventually use to do things like share buybacks, and that's what they're like. It's like the auto zones of the world, right? Where you saw a whole bunch of share buybacks, and that's
right.
like one of the reasons why they had such a strong showing in terms of like the stock price.
And for those of you guys that don't, we did an episode probably a week or two ago, probably 2 or 3 weeks ago rather, where we looked at AutoZone and their earnings have only grown like, and this is so good, right? 6 to 7x over the past 20 odd years, but somehow magically the stock has gone 50 to 80x. And so we were like, well, what's the difference, right? Well, if you look at the share count, they used to have something like 200 million shares outstanding, and now they're down to like 20 million shares outstanding. So they bought back about like 85% of the shares on the market. So you take the fact that they only have 15%, one divided by 15% is about 7. And then you look at the 7 or so, or 8%, 8 times increase in the revenue, you times 7 times 8, you get to the 50x that you're kind of looking for. And the share price has done the same exact thing, right? So you start to understand what Chris is kind of talking about, where you continually increase in the amount of revenue plus prudent share buybacks that are actually meaningful, and you can have a very impactful, I guess, increase on
Return.
the share price.
Yeah.
Yeah.
So right here, this is Nexstar Corp's presentation that they did in January. So this is all the stuff like one of America, like the CW, they have a 75% ownership for the networks. They own the Hill Food Network. They have 31% ownership of that, News Nation. But basically, you can see, well, here the stock performance is there. 86%, I mean, 68% of US population via its local TV stations. So there's still a lot of people that watch local TV for morning news and all this other
Right.
stuff. So yeah, like, hold on one second. What was the thing that really attracted me? Okay, right here. So their Q3 revenue in 2022 was about $4.9 million. I mean, 4.9 billion dollars in income. They have like a moat because like all of the stuff that they have are like local assets. No one really takes, like I said, no one even looks at this. Like it was really hard for me to find it, but whatever. So this is their revenue on a not revenue. Hold on, where is it? Distribution revenue, shareholder returns, right here. Adjusted shareholder returns constantly 54% of their free cash flow right now is going to share repurchases, 27 to debt repayments. But look at the crazy amount of share repurchases that they're doing, and this is last year before the election cycle, when spending tends to just go crazy. So it's a really high free cash flow business. Maybe once I finish doing the DD on this, we can both take a look together, and maybe you can actually take a look as well and do your own DD as well and see if
For
there's
sure.
if there's a way that we can see if we can make some money on this.
For
Yes.
sure. But I think this is probably prudent because you mentioned it a few times. So let me pull it up, which is kind of the shares outstanding. Now, I
Yeah.
anticipate these are splits, right?
Yeah.
Like
Yeah.
1.5 splits that are kind of increasing. So that's why you're seeing these big jumps. But what Chris is kind of talking about here is you can see going from about 45 million shares outstanding close to 35 million, or maybe it's closer to 38 million. But regardless, that's 20% of the float, right? So if you're able to buy back 20% of the float, of course, your earnings per share and your share price are all going to kind of coincide with that, right? So it's just another opportunity to kind of look at when it comes to, all these different avenues, right? People are so strict on price to earnings, and it's like you have to look at all these different things. And not only that, but things that might be particular for a certain industry, right? Like you wouldn't look at monthly active users for an oil company, but you might look at monthly active users for a technology company. So it goes back into one of these things where it's like you can't just blanketly say price to earnings needs to be 15x, because for companies like this, it's going to be way lower, right? Versus an Apple or a Microsoft or a Google, it's going to be in the 20s to 30s.
Yep. Yeah, man. But yeah, these are like small things that I've been researching, but there's not really much else to research. I think I'm pretty good with the stable of horses that I have.
Yeah.
Google is my main position right now, followed up by SLG. I have a little bit of Amazon. I've got a lot of regional banks, so I'm betting on like 5 or 6 regional banks.
Mm-hmm.
What I'm very, very interested in right now is the 2026 call option set. Like, especially on some of these companies that are like been beaten down. Like, I think the 2026 options when they come out are going to be pretty good. I'm not going to buy them right away. Probably going to give it about 30 days. But yeah, I think there's a lot of pockets of opportunity that maybe people.
You mentioned spreads. I mean, there's so many different ways we could take the last few minutes of this. You mentioned spreads. Are you looking for something where you're able to just pocket, something that's slightly out of the money, slightly in the money, and then selling a covered call, or I guess like a synthetic or poor man covered call, just to be able to kind of, I don't know. I'm just trying to understand what your spreads are really looking like, to be able to kind of benefit from some of these things. Or we can go into what we think the last half of the, or I guess last 4 months of the year will kind of look like.
So we could do both real quick. So the spreads that I'm looking at, they typically are way out of the money. All right. Yeah. What happens is when stocks take a deep nosedive, markets become irrational, and you can benefit from market irrationality, especially via options, but you have to just know what the fair price is that it's supposed to be trading at. But then also there's a couple of things you can do to like mitigate some of the risk. So if you just buy like a naked call option way out of the money, you're literally hoping and praying that it goes up to what you are, way beyond your strike price, right? That's one way to play it. And the thing is, like, your total returns may not, and over time, your return is going to decay, because what's going to happen, you're going to have theta decay happen. So let's say it doesn't happen. So you kind of want to be as far out as possible for the scenario that you think is going to happen, and then also not have to pay a ton of money in premium that's going to get wasted away. So with a spread, you're able to kind of utilize the premiums from the top portion of your price target to basically mitigate some of the cost of your lower strike. So what ends up happening is, even if you see like slower growth in the company or flatter rises, what's going to happen is the theta decay on your short call is going to decay really fast, and basically you'll be able to eke out a good return. So that's why me and Amit, when TFC earlier this year had dipped below, a certain amount, is like $27 at the time. I was like, wait, the market, the book value of this company is like in the 40s and 50s. So from a risk to reward perspective, these options make a lot of sense, because they only cost us $3 at the time. And so there was a lot of time premium also, because the options that we had were like so far out. So that's when we did a spread on TFC, and it went from like $3.50 to like $6. Now, the thing is, yes, have we stayed in, we could make more money, right? We could get we could get better pricing. Like literally the spread was a $15 spread, and we, it was around $6.25. But at the same time, the macro was kind of weakening a little bit. Inflation was starting to come up. So, we had already gone up 100% in less than 60 days. It was like,
Yeah.
why aren't we selling out of this position? So I told Amit, I was like, we need to get the hell out. We could chill a little bit. And Amit's like, no.
At least sell a portion where you're playing with the house's money, right?
I said the same thing. Same thing. But he's learning. He's learning over time. Yeah. So then they dropped back down to like $3.15. And lately, because the regional banks have been rallying a little bit, it's back up to like $4 right now. So the point is, there are times where the risk to reward scenario becomes so great that you can't help but just take the chance and do it. And usually, usually you want to, like I said, these are like quicker hits than quick hits and runs, rather than trying to like stay in it the entire time,
Right.
But
and the reason why I bring up the VIX, right, is because I don't think people really understand that underlyingly, the amount of premium that you pay for some of these long options is, or maybe it's more short-term options, but even still, the volatility index plays an impact on what you're paying, right? So if you have a very volatile market, it just means that the standard deviation away from the current strike price is really going to be elevated, and people think that it could swing much more volatile because of the market that's at hand, versus right now we are very low volatility. So in this case, if you want to buy a leap or something that you think is going to do well in the long term, now is a good opportunity, because you're not going to be paying out the butt. And the same thing happens after a big price move. Like, for example, at TFC, you probably paid an elevated premium based off the fact that TFC dropped so harshly in March. One, because volatility overall for the market went up. And then two, just the fact that the stock itself probably decreased by a substantial amount increases the standard deviation away from the strike price as well. So there's two things where it's like you kind of want the stock to settle down a little bit. So there's that, that kind of like, there's the theta piece, which is time respect. And then there's the alpha piece, which is just overall, like, how much is it actually, is it alpha, or is it, I'm trying to remember the Greek specifically for it.
For what, return?
No, the basically the implied. I'm looking for implied volatility.
Delta.
Yeah. So the implied volatility of each individual option is going to be much higher. So you want something that's kind of settled down.
You're talking about delta.
Is delta related to implied volatility, or I guess
see.
Yeah. I'm just thinking, like, when you have like GameStop, for example, was trading at several 100% back in 2021. It's like
Vega.
You're gonna be paying,
Vega.
You're going to be paying out the butt for a premium for that opportunity, because the volatility of it was out of this world, right? Nobody thought it would go to $400, versus like right now, you could buy a call option on Verizon and nobody's really going to blink an eye, because Verizon's probably one, not moving very quickly, and then two, you have a low volatility on the overall market as a whole. So
yeah, these are the five main options Greeks. Delta is the rate of change, right, which represents the sensitivity to the options price to changes in the value of the underlying security. So if the deltas, read up on it. I'm not a big user of the Greeks, to be honest with you. I do more on valuation than that. Theta is the rate of time decay of an option. So as time goes, what ends up happening is the premium that you have on an option tends to go down. So that's the decay time. So companies that are really far out, they don't decay nearly as fast. So usually when you're looking at like a theta decay chart, you're looking at this right here.
Minimal when it's far away, but as soon as you get closer to that expiration, it exponentially increases.
So that's why if you are an option seller, usually you want to sell 30 days out, right? So basically you'll have the maximum amount of decay that's coming up. So let's say if you want to sell a covered call, which Matt does all the time, usually how far out calls do you usually sell, Matt?
It depends on the position, but if it's like a Palantir, it's a weekly. If it's something like a Pepsi, something that's a lot less volatile, that'll be 30 to 45 days out.
Yeah, so
Yeah.
that this way, what happens is as long as it's like really up way above the currently the trading price or the stock price, that decay happens really fast at the end of the decay cycle.
Yeah.
So that's theta decay. And then hold on,
Because
options.
let's just say, for example, it's a quick example, and I'm not going to go too much detail. Say a stock is trading at $40, you sell a covered call for $50, and you're able to get $1 in premium. Well, if the stock stays at $40 and yet you're closer by, say, 3 weeks to the expiration date, you're basically just the likelihood of it going from 40 to 50 decreased because the amount of time you now have is a lot less. That's basically like you're throwing a penny every single day, right? So for let's just say you have an
Yeah,
option for 90 days and it's a dollar premium. So the delta is probably going to start off at something like half a cent a day, but towards the end of the kind of expiration date, the theta is probably going to grow, right? Just like you were kind of seeing how it exponentially kind of decreases. So eventually it's going to get to a penny per day. Then it might get to a penny and a half per day, 2 pennies a day. And the thing that's nice is if you sell options, you can always buy them back at a cheaper price. So if you're just sitting there and the price is hanging out at $40 and you still have this $50 short call that you sold on this company, you could buy it back. And now that premium is, whatever you bought it back for, that delta between the two is well, I shouldn't say delta. The difference is yours to keep, and there's no risk anymore, right? You bought it back, you've
yeah.
eliminated the position, and you're able to keep the difference between what you sold it for and what you bought it back for.
Yeah, and the other two Greeks three Greeks is Gamma, Vega, and Rho. Rho is not nearly that important. I mean, it's
Yeah,
more
never
to do
really.
with, yeah, with interest rates. Vega is the one that you were talking about, by the way, with sensitivity to volatility. So
Yeah.
basically, it'll, based on the volatility that's happening, you'll see Vegas go crazy up and down. So
And you can make money. So that's the thing, is like understanding how each of those work, you can make money off of it. So if you see something with a very high Vega,
no, I'm
and
gonna I'm gonna just I'm gonna disagree with you on that one. I'll tell you why.
yeah, I'm fine with that.
Back in the day, you could theoretically set up ways that you can play the options and actually make money in the short term when things went haywire. But dude, let me tell you, these high frequency traders and these high frequency companies that are specifically built to eke out every single penny of easy money of ARB, it's crazy, man. It's not worth trying to fight these guys. Like the minute you think you found a good deal on the option side, boom, one of these guys will pick it up and take the position out from under you.
But
So
are you
it's like,
talking about
yeah.
long spreads or debit spreads? Or are you talking about credit spreads or
No,
both?
no, no. I'm talking about just options in general in the
Okay.
like short term options, like Citadel. Like very few times have I ever come across a point where you could theoretically make risk free money.
Mm.
That's the thing. These high frequency traders, they are just eking out money right and left, just pumping that out of the system. So no, I don't think there's a lot of opportunity in the short term. On the long term side, none of these Greeks make any sort of thing. Like if you go at like a 2-year option leap, right?
Mm.
And you're looking at the thetas and that,
Theta
none of that
doesn't
shit.
matter too. Oh, yeah.
Throw that shit out the door. Okay. Implied volatility, throw it out the door. No, focus more on the company rather than the Greeks, because what happens is there's so much time premium that none of these things make any sense whatsoever. So that's the only time where you as an investor have an edge over the computers, because what happens the computers can't do is they can't think theoretically nearly to the point that we can think theoretically, right? So like an example that I was trying to give like last time was like the chicken wing. The prices of natural gas goes down, fertilizer prices go down, which means chicken feed goes down, which means chickens get cheaper, which means Wingstop makes more money. Like that kind of logic, I don't think the computer really figures that out yet. Like maybe they'll figure that out eventually, but like what does the weather in Iowa have to do with the price of Wingstop? I don't think any computers figure that out yet, except humans. We do really good with figuring data points out that other people
There's a
may
lot of
not be able
chickens
to
in
figure.
Iowa. That's all I know.
Yeah.
That's an interesting. Let's finish up with,
Mhm.
and or maybe we could save it for tomorrow. You tell me. But the the
Yeah.
the last few months of the year. Do you want to save that for tomorrow, or do you want to? Um,
No, let's talk about it real quick.
okay.
Um, what do you think? What do you think is going to happen?
So we're not in an election year. That's next year. So everything in an election year, next year I think is going to be, especially the second half of the year, is going to be very bullish, especially up to the election. And I think that will be consistent. I'm fairly confident we're going to see another interest rate hike, which, based off the market at the moment, I don't know if it's priced in or not. And so, if that's the case, I think we might see another 5 to 10% pullback. But I am very confident that we'll start to see more inklings. At least I thought. I mean, by this point, I thought we would see more inklings of kind of taking the foot off the gas in terms of the interest rate hikes, and I thought we were kind of done. But with the news that continues to come out of increased jobs being taken, and the lack of supply, I mean, it's kind of crazy in that respect. And um, it's not like jobs are sitting out there super vacant. So anyway, it's just, to me, it just seems like the economy is just way stronger than I would have kind of given it credit to. If you asked me 2 years ago, I'd be like, I don't know, this thing's kind of on its knees. But to me, and I don't know if it's just the amount of money that's still kind of like sloshing around the system with $8 trillion on the Fed balance sheet and stuff of the like, it just feels like things are still kind of booming. Housing prices are still kind of going up. I didn't expect that. And I think a lot of that has to do with there's so few people kind of selling, that the demand of houses is still on the rise. So I think we'll probably see another 5 to 10% pullback, as I kind of thought we were probably about a month ago. We'll kind of, as we raise interest rates again, probably get spooked again. But as we enter November, December, I think we'll have a classic Santa Claus rally. And I think we'll probably end up at where we are today, if not probably getting close to, if not back to all-time highs. But I've been wrong before, and I'll probably be wrong here. So,
I think it's going to be very sector dependent.
mm,
Usually times like this, just some sectors are going to have a lot of bullishness, some of them are not. I think right now AI is the sector that you want to be in. Well, technically there is no AI sector, but AI is still relatively early in its growth phase right now. There's still so many things that are coming out right now that are like AI products. I do think that there eventually is going to be a bubble burst with the AI sector, but for the most part, I see a lot of value still being generated, and so
mm.
I would say I'm leaning one of my portfolio like areas that I'm focusing on is just AI and AI development. Another one is around a a scenario where we start to see interest rates start getting cut. Um, I think September there's not going to be a rate rise. I think that's actually going to be a pause, and
Hmm.
the reason for that is because one, there's already so much disinflation happening around the world. Eventually, it's going to come to us, and the last thing you want to do is try to raise interest rates while everyone else is like holding them still. So, like today, Australia
Yeah, well, I wanted
actually,
you said that
yeah.
the other day on Finance Junkies, and I was really curious. So you're saying that we're gonna, from the globalization perspective, like everyone else is kind of sneezing with respect to kind of disinflation, and we're kind of gonna catch a cold. Is that what you're saying? When I heard you talk about it the other day, I thought that you were saying that we're kind of seeing more of that in the U.S. You're talking about China. You're talking about all these other nations that are really starting to get to a point of very recessionary like trends, and that's going to impact the US. Is that what you're saying?
Well, the pricing wise, yeah. I mean, if the price of goods sold by other countries, exports, are cheaper, that means that for us, that means that the products that they sell us are cheaper as well, right? That's what it is. So basically, when the entire world is, because remember, we are a net importer of products, goods, and services, right? So that means that all the stuff that is coming to us is going to become cheaper. So if it becomes cheaper, that's good for us, right? Food prices overall have like the price of let's just take a look at all the trueflation data real quick, because I think that'll help. Okay, so right here, according to Trueflation, inflation's about 2.64%. By the way, that target of under 2%, that wasn't like 2023 target. That's a 2024 target. But we've just got really good, and we've come down significantly since
Mhm.
since that period. The
I didn't
problem
think we are
is that
going to get out of the fours in 2023, to be very honest with you. So I'm
yeah,
very
I didn't think
surprised at
so
where we're at.
either. I didn't
Yeah.
think so either. You know, but look at this one. The price of housing. Rents have pretty much flatlined year over year, right? Yes, you're seeing some growth in housing, like how costs of homes themselves, like purchased homes, but that's primarily because there's an inventory problem in there. But that's getting resolved. But
I think
rent
that's
year over
select
year is pretty
markets
flat.
too. There's still some
Yeah,
markets that are
yeah.
really, really bad.
Oh
Like I
yeah,
think
yeah. No, it's definitely
Austin right
select
now,
markets.
Austin's in,
Yeah,
like I've seen some houses that are just going up for, they're getting slashed very heavily in Austin. So I think you'll see like a lot of, back in the 2021, 2022 days, you were seeing some places go up for 50, 60% year over year in terms of pricing. I think a lot of those
yeah.
places like Idaho, Austin, some of those high destination areas are seeing the exact opposite in terms of
Hmm.
what's kind of been going on since kind of the everyone's going back to work and stuff like that. So those
Yeah.
places that saw the best prices, understandably, are kind of getting hit the most.
Yeah. Like right now, gasoline prices are starting to come back up, but that's primarily because like the Saudis today just announced that they were going to cut back on production, right? Earlier today. Did you see that?
I did not.
Yeah. Yeah, the Saudis basically said that they're going to try to just support the oil market. So that's like flatlining and gasoline prices are pretty much, let me just look at prices. Hold on a second. Look at the
It's up
futures
to
right now.
86.75,
Yeah.
257. Look,
Brent
use
is
the
at
ticker at the
90?
bottom, my guy. Yeah.
Oh, I forgot that. Brent is a what price is WTI and Brent right now? Let's see. 86. Oh shit. Okay. All right.
Yeah, man,
That's
it's
not
crazy.
good. Henry HH gas is Henry Hub. That's 2.75. That's not bad. I'm focusing on a
It's
lot of natural
cheap.
gas stuff, which is good. Yeah, I mean, it's going to be left to be seen what happens by the end of this year, but I'm not overly bearish, but I'm not overly bullish either. I don't think there's I think the market is pretty fair right now. So the best thing to do in a fair market is just hold and relax
Hmm.
and maybe sell some covered calls here and there if you really want
Hmm.
to. But the way that I'm positioning my portfolio is I'm trying to capture alpha from a probable rate declining scenario happening in 2024. I don't know
Hmm.
when it's going to happen. Maybe it's in the latter half of 2024, but that's how I'm positioning myself. So a lot of companies that like took a huge hit primarily because interest rates went up, they're likely to be the first ones to recover when interest rates start to go down a little bit. And so their balance sheets are not going to look as poisonous as before. So,
So you thinking
that's
micro caps? I guess my thought probably, are you thinking like Russell 2000 is going to do really well?
yeah,
You think
The Russell will do well, but it depends on which sector. Like the regional banks is where you want to be, basically, dude.
right,
Like
right.
I would say, look at the regional banks around you. Find the ones that have good businesses, management that's able to maintain some semblance of profitability under the recessionary scenario. Delinquency rates are at a not an all-time low, but delinquency rates are manageable. High CET1 ratios. And once you find those, just buy some of those up and just relax.
Hmm.
So
What
yeah.
about TLT, the 20-year Treasury index? Are you
That
gonna?
that could be worth investing in. Me and
Yeah.
Futbucker at one point were
Oh, really?
thinking about doing that. Yeah. But
Because
we
it's kind
kind of
of
like,
flatlined. It's like, okay,
yeah,
I think it's waiting for that point where it's like, okay, we're gonna cut it, and I'm like,
yeah,
ooh, if you could buy the right spreads for that, I think you'll do okay. Um,
yeah,
yeah.
yeah, yeah,
Cool.
man.
Well, the last thing I will say, and to finish up on that particular topic, not jumping into another one because I know we've already run over, but the thing that I realized now, which I think was always said, but I guess I was a little bit naive about, was at this point where we're kind of in the low threes, getting into the high twos in terms of inflation. I thought that was like a signal for them to be like, okay, let's start cutting rates and kind of meet ourselves at like, and eventually while you're cutting rates, you're going to continue to come down to two. And it seems
Mhm.
almost more like what you're kind of saying, and much what I've kind of heard JP say, Jerome Powell, is like they're almost like waiting to get to 2% and a hard 2% and not 2.1, not 2.2 before they really start to cut rates. And to me, I'm like, I feel like there's going to be a big difference between getting to 2.7 to 2. And I think that that's where we're going to see something that I think was probably going to happen a lot sooner, or rate cuts. But I think that that's going to add the extra 6-7 months that I wasn't really anticipating, because I was saying, okay, once we get to below 3, we're basically back. Well, that's 2, right? Below 3 is 2. But to them, it's like 2.0 is 2, right? Not 2.5, not 2.6, 2.0. And they keep reiterating that. And I'm like, oh shit. Okay. Maybe now I start to understand the picture of why some people have been very bearish about when they're actually going to cut rates. So anyway, I don't know if you have any thoughts about that, or we can finish it there.
No, let's finish there. I just want to show a video real quick. I'm gonna do more DD on LLY, which is Eli Lilly, but I just want to show you. I just want to show you guys the drug that hasn't been released yet, but could be a game changer, like way beyond Ozempic and even their other product, Mounjaro. So let's take a look. It's about 4 minutes. Hold on.
Eli Lilly's new drug is called retatrutide.
When we saw how they worked in our preclinical studies, and then when we saw how it worked in patients for the first time, we knew we were on the verge of a breakthrough.
Unlike FDA-approved drugs Ozempic for diabetes and Wegovy for weight loss, which harness one hormone to control eating, according to Eli Lilly, retatrutide harnesses 3.
We think that a medicine like this could someday offer the same levels of weight loss that you can see with bariatric surgery.
In retatrutide's second clinical trial, patients with obesity lost up to 17.5% of their body weight, more than 40 pounds, in 24 weeks, nearly 60 pounds in 48 weeks. Jacinthia Jesse weighed close to 300 pounds before taking part in the trial.
It has been a roller coaster ride for many of my adult years.
While some participants were given a placebo, she believes she got the real injection, dropping 60 pounds.
Having to put on clothes and realize that this is not my size anymore. Like, I literally have to go to the Goodwill, give these away. That was just life-changing to me.
Testing is in its early stages. A submission for FDA approval is years away. But Eli Lilly is hopeful it will get FDA approval for a different drug this year, the weight loss version of its approved diabetes medicine, Mounjaro.
There are analysts who say it'll be the most lucrative drug ever made. Hyperbole?
Probably, yes.
Look at his response is like the typical greedy pharmaceutical. It's like, no, we don't care about profits. We care about people. And inside, look at his hands. Look at where his hands are positioned. It's like the body language. Let's just watch the rest of it.
I think at Lilly, we try not to focus too much on which drugs are going to be really big sellers. What we try and focus on is, are we making medicines that treat a deep unmet medical need?
Eli Lilly is not.
Yeah, so go ahead. Give it up for free then, buddy. Give it for free if you care about people, right? Nah, dude. He's like, he's like this on the inside. Let's just watch. Hold on 1 second.
Alone in its push to research new drugs. Other pharmaceutical companies are doing the same. While obesity doctors say the medications that are on the market have already changed lives.
It's been transformative, to say the least. I think it's given so many people hope that felt sort of helpless in this fight against the disease of obesity.
The next step will be getting the medication in pill form, which Eli Lilly is working on. Easier to make and easier for people to access.
We hope that obesity will be something that we can...
Look at him. He's not even moving his hands from the greed position. That's the greed position right there. That's like, I got you, bitches.
Reverse for the majority of patients. And in doing so, it's not just about how they look or how they feel. It's for patients, it's really, we believe, a change in their overall health.
I mean, targeting obesity obviously is so important for lifestyle. I think a lot of people who see these drugs are thinking, well, I want to drop some pounds too. Can that work for me?
That is not what these drugs are being approved for. There's only one weight loss drug on the market. Eli Lilly has a couple that they hope to get approved. They are specifically for people struggling with obesity, and those are the people who are in these trials. It is not people just looking to shed a couple pounds.
Well, speaking of weight loss topics, there was another study out. This one had to do with intermittent fasting versus just traditional calorie counting. Which is interesting. Which diet is better?
Which one's better? So this is out of the University of Illinois, and it might be good news for people who don't like to calorie count. And it showed that intermittent fasting, so not eating between.
Okay, we can talk about. Hey, TJ, I didn't know you were on. Plus, you bleed a little from your rectum. TJ, I'd love to interview you on how the Manjaro is affecting you, because
absolutely,
Manjaro is going to be Manjaro. By the way, is the Eli Lilly drug that's there specifically for diabetes, but people to lose the weight, because if you get if you have obesity complications, you kind of want. So it's probably one of the most effective drugs. TJ, I don't know if you're comfortable saying how long you've been taking it and how much weight loss you've done, but I've seen people lose a ton of weight. Like one of my coworkers the other day, I just saw him in the office because I was in New York. I think he lost like 50 pounds, man, since the last time I saw. TJ's down 50 pounds. Fucking nuts, dude. 50 pounds.
I don't think TJ's like somebody like me. I could probably lose a shit ton of weight. Like I think a lot of these, I'm way overbeat. I mean, it's compared to some of these people that I've seen. So
man, that's not good, man. Come on, you want to be a healthy 65-year-old. Man. You need to start shedding that weight now, man.
I know. I need to. But the thing that concerns me a little bit, while it is enticing, these drugs, and it look, the thing, I don't do well with needles, so that's one. So I need to stop being a little bee and actually just man up if I were to ever actually do it. But two, I've seen some mixed results with respect to somebody mentioned it earlier in the chat, but I've seen the same, which is it's like 50-50 fat versus muscle loss versus like if you do healthy, it's more of like a 75-25, 75 fat, 25% muscle loss. And so that makes me a little bit scared, because I've always like, I'm not bodybuilding strong anymore, but I've always had a lot of muscle, and I've always kind of worked out to an extent and weight trained. And so in that respect, like, 225 was never that difficult. If I trained for a few weeks, I could probably rep it, get back up there in terms of benching pretty quickly. So like I have a lot of underlying muscle, which I think helps a little bit, but obviously there's a lot of fat too. But yeah, that's my fear, is it's like, am I going to lose a lot of that muscle too? So I end up being somebody that's way thinner than I would want versus somebody that's a little bit more muscular, which would be what I want.
Yeah. Well, I mean, you'd have to like work out at the same time to like keep the muscle mass going, so that this way, because a lot of this stuff, there are side effects. So listen to your body. Okay. We will. But TJ says can barely feel it, need to keep working out. That's good. I think what it is a lot of times people get into a place where they get so overweight that it becomes really, really hard to get over this hump of getting into like the gym and exercising. And this is just something that like could be a booster, get them into your muscle retention is the least of your worries right now, to be honest, Matt. You got to fit a little. Yeah. I don't know, whatever. Not going to go too far into it, but basically congrats TJ on losing the weight. Keep it up, dude. I hope you get to the target weight that you need to be healthy. Obesity has so many complications to it. I don't think that this is something that people should use regularly, but if it's something that gets them to a point where they can get to like a manageable weight and then sustain that, might not be a bad thing.
For sure.
Yeah.
For sure.
You know what, TJ, one of these days, since if you have some time, come on the show, man. Maybe later this week, if that's okay with you, Matt.
Yeah, yeah. I mean, I didn't want to steal it, but I mean, if you want to do it on here, I'm more than happy. Or if you want to do it on your own, let me know. I don't want to steal it. It's more of your.
Yeah, TJ the Wheel Deal is a really great guy. He does a lot of option selling, so I bet he could probably give us some good pointers, and the viewers some good pointers on how he approaches the market. Because I mean, he does it regularly. Yeah, I've spoken to.
I
him
don't
a
even
couple of
think. I mean,
times.
other than options that got put to him, or that, you know, basically due to his option strategy, his wheel strategy. I mean, that's why they call him the wheel deal, right? Other than that, I don't think he really holds shares. And even if he does get assigned shares, I think he's always trying to get out of them by selling covered calls. So it's a different way compared to like what I do. I'm more of like an equity long-term kind of holder, and I sell far out of the money covered calls. He's very close, right? Like he's kind of doing that like 70 delta or like 30 delta on either side, and you know, hoping he gets assigned sometimes so that way he can turn around and sell covered calls. It's pretty interesting. Anyway.
Yep. Yeah. Interesting, man. It was a pleasure talking to everyone. All right. Take care.
Yeah. Thank you, guys.
Have a good one, guys.
Cheers.